Second part of the question, it says like this: define weighted marginal cost of capital schedule for the company if it raises rupees 10 crore next year, given the following information. So the amount to be raised is an amount of 10 crore, and for that say we are required to compute the weighted marginal cost of capital. Means we are required to compute the cost of capital in respect of only this 10 crore. The word marginal stands for incremental, differential. So keeping aside the existing capital structure, we are required to make the computation that what is the cost for these 10 crore of the funds. It has been given the amount will be raised by equity and debt in equal proportion. So what will happen, out of 10 crore, 5 crore will be the equity and 5 crore will be the debt financing. The company expects to retain 1.5 crore of the earning next year. So we have been provided that say out of 5 crore of the equity financing required, 1.5 crore will be the retained earning and the remaining 3.5 crore will be the new issue of equity share capital. The additional issue of the equity share will result into net price per share being fixed at rupees 32. So if at all we will come with the new issue of the equity share, then in that case we will not be able to fetch 40 rupees per share. In order to make sure that the issue is becoming attractive, we are required to issue the security at a comparatively lower price. So it has been given that say we are going to issue it at the rate of rupees 32. The debt capital raised by way of term loan will cost 15% for first 2.5 crore and 16% for next 2.5 crore. So in respect of the debt financing of 5 crore, again the bifurcation is given. What would be the cost for the first 2.5 crore and what would be the cost for the remaining 2.5 crore. Taking all this information into account, we are required to make the computation of the cost in respect of only this additional 10 crore in a way that say whatever the project in which we are going to make investment of this 10 crore, from that what is the minimum rate at which we have to earn from the business, that we are required to calculate. Let us answer the second part of the question. Working note number 1. Calculation of pattern of raising funds. It has been given that so the 50% will be equity and 50% will be the debt financing. So debt financing is 5 crore. It is 10 crore into 0.5 and the equity is again 5 crore. It is 10 crore into 0.5. In respect of the initial 5 crore, we have been provided with the information like this. For the initial 2.5 crore, the rate of interest is, I think, 15%. Yeah, and for the remaining it is 16%. So 15% is the rate of interest for initial 2.5 crore and 16% is the rate of interest for remaining 2.5 crore. As far as the equity financing is concerned, in that say again there is a bifurcation. The first one is the retained earning. It is an amount of 1.5 crore. And the remaining is the new issue. So new issue is the balancing figure, that is 3.5 crore. This is the way we are required to have the bifurcation of the raising funds. Next, working note number 2, calculation of cost of debt financing. It is interest into 1 minus t divided by amount. For the first 2.5 crore, the rate of interest is 15%. Plus, for the additional 2.5 crore, the rate of interest is 16%. So this is the total interest into 1 minus tax rate. Income tax rate is given to us in the question. I think it is 40%. Yes. So into 1 minus 0.40 divided by 2.5 crore plus 2.5 crore. So what will happen? 2.5 into 15%, so 0.375 crore plus 2.5 into 16%, that comes to 0.4 crore into 0.6 divided by 5 crore. So 0.375 plus 0.4, so 0.775 into 0.6, so it is 0.465 crore divided by 5 crore into 100 for getting answer in percentage term. That is the way we will make the calculation of the cost of capital. So 0.465 divided by 5 into 100. So the cost of debt financing is overall 9.3%. Next, calculation of cost of retained earning and cost of equity. Let us see how to make the calculation of answer. Dear students, we understand that as far as the calculation of the cost of retained earning is concerned, we will use the existing market price of the equity share. And for calculation of the cost of new issue, we will take into account the new security price information given to us. So as far as the cost of retained earning is concerned, it is D1 divided by P0 plus growth rate. D1 is 3 rupees 60 paise. Current market price is 40 rupees. That itself is required to be taken in calculation of the cost of retained earning. Plus growth rate 0.07, 0.09 plus 0.07. So it is 0.16, that is 16%. Now importantly, for cost of equity for the new issue, we will use the same formula. The formula is not going to be different. However, we understand that this time the price of the security that we are required to take would be different, because the question is providing the information that the net price that we are going to receive will be an amount of rupees 32. So divided by 32 plus growth rate 0.07. So 3.6 upon 32, so 0.1125 plus 0.07, so 0.1825, that is 18.25%. This is the way we are required to calculate the cost of equity for the new issue, and cost of retained earning we already have found it, or otherwise you may find it once again as you want. Students who have completed writing this portion are requested to proceed for marginal weighted average cost of capital calculation. So let us see calculation of weighted average cost of capital. In that sense, it is the marginal weighted average cost of capital. Column number 1 will be again the source of finance. Column number 2 will be amount. Column number 3 will be weight. Next is cost, weight into cost. As far as the debt financing is concerned, it is 5 crore. Retained earning is 1.5 crore. And equity share capital is 3.5 crore. So the total is 10 crore. So the weight of equity, so debt financing is 0.50. We already have found its cost is 9.3. That is, so the cost in respect of the entire debt financing is found. Then retained earning 1.5 divided by 10, that is 0.15, and this is 0.35. The total would be obviously 1. For the retained earning, we have been provided with the cost. It is 16%, and for equity it is 18.125. So weight into cost will give the weighted average. Right on answer. Friends, it is 18.25. I'm sorry. So here weight into cost. So 0.5 into 9.3. So it is 4.65. 16 into 0.15. So 2.4. 0.35 into 18.25. So 6.3875. So it is 13.4375. That is the weighted average cost of capital or overall cost of capital. This is the way we are required to do answer. Now friends, over here, just one point that I want to tell you is, let's say the word which has been provided over here, the marginal, means we are required to find the weighted average cost of capital only in respect of this additional funds of 10 crore. Whatever the existing financing that say we have, that is not required to be taken into account. Write down a note for the answer. In calculation of marginal slash incremental slash differential cost of capital, comma, we have to consider only additional financing and we will ignore existing capital structure. Full stop.